Hello friends, have you ever been confused to how to go about investing in a mutual fund? Is it the SIP way or the lump sum way? Here I am to exactly explain you that which is a better way to invest. And I'm also going to give you some rules which will definitely make you a better investor and take a better decision. So let's start. So here it is. So first you have to understand that how does SIP work and how does lump sum work? Now, what is an SIP? It's basically you are putting a fixed amount on regular intervals, which could be monthly, weekly, quarterly, or annually. In lump sum, you are making a one-time investments and you're going to just let it be. Now, SIP is in one way, it's very beneficial for someone who is having a regular income, either from business or from simple salary. In that case, he can simply match the salary day with the SIP day and can continue to invest in the equity fund. In case of lump sum, it is usually relevant for those people who will probably inherit some wealth from their parents, or they make a sale of some big property or big assets, either a gold or some land. In that case, you will have that lump sum amount. In SIP's case, the starting point could be as low as 100 rupees, while in lump sum, it can start at a slightly higher, which is 5,000 rupees. So SIP is basically relevant for all sorts of people who have a very small saving as well as who have large savings. Now, SIP works well, especially when there is an uncertainty of how the markets are going to behave and if there is going to be a volatility in the near term. In case of lump sum, it works very well when you know that markets are probably reasonably priced and they are likely to go up. Now, in SIP's case, like we saw that if you invest regularly at various intervals, you are going to get a best average price for your units. In lump sum, all you are going to get is whatever the NAV price was on the day of investment. So now let's see, there are some obvious periods where SIP can do better than lump sum. And there are some other periods where lump sum would have done better than SIP. And I'll also tell you what are the thumb rules to choose between the two. So this is the first scenario. Now here is one case where lump sum will do better than SIP. So I've just used this as an illustration, and this is not the actual market prices, but I'm assuming that this is how a typical marketplace also behaves. So in this example, for instance, hypothetical NAV is at 100 at the starting point, and it goes all the way up to 125 to 150. Now, I have assumed the 12 intervals. It may mean months, quarters, annum, it can be anything. But here in this example, let's assume it 12 intervals. So there is a two choice with you guys. One is 1,20,000 available to be invested in lump sum fashion, or you break it up into 12 equal installments of 10,000 each, and you invest at every interval. In this case, the SIP would have accumulated approximately 1,020 units. And the average price would have been 118 rupees per share per unit. However, in lump sum, because you had chosen to invest right at one go, you would have accumulated 1,200 units right away at the average price of 100. Now, in this situation, we are assuming that markets are undervalued at the start and they are likely to go up in future. And in this case, you can see that the lump sum would have done better than the SIP. The final value of lump sum is 1,80,000 versus SIP, which is 1,50,000. So why does that happen is because the starting price was low and you would have bought all the units at a lower price and you would have turned up with a bigger gain. Now, how to identify whether markets are undervalued or they are likely to rise in future? So there are some thumb rules which we will discuss. The first one being the Nifty PE ratio. Now, this is a valuation tool which helps you determine whether markets are undervalued or fairly valued. You have to compare the current Nifty PE with the long-term median of Nifty. So in long-term median of Nifty stands at 20 times price to earnings. And if the current PE is at 20 times price to earnings or lower than that, then in that case, you can assume the markets are probably fairly valued or undervalued, and you can go ahead with lump sum investments. Because what is going to happen from this price is markets are either going to deliver immediate gains or they are likely to generate reasonable returns in the future. They may go down in the interim, but however, the likelihood is that they will generate a better return. There is another rule which can be used looking at the last 10 years and 15 years SIP returns of Nifty. If the SIP returns of Nifty are higher than the long-term average returns of Nifty, which is 12 to 13%, in that case, you can assume that the another thumb rule which you have to use is whether Nifty's SIP returns over last 10 to 15 years are lower than the long-term average returns of Nifty. So Nifty in long term has averaged at 12% CAGR, and if the returns of SIP of last 10 to 15 years have been lower than 12% CAGR, it means that markets are probably fairly valued or undervalued. Now, these two methods are not a very short way of saying that whether markets are undervalued, but they are definitely a better anchors to make a better decision. Now, these two methods, they are not necessarily the secret formula to know the markets are undervalued or not, but definitely they will help you in making a better decision. Now, moving on. Now, in which scenario does SIP do better than Lumpsum? It is usually when the markets are likely to be volatile in the short term and they are likely to be overvalued in current situation. So in a similar manner, what I have assumed is in the hypothetical NAV, I have assumed that at 100 rupees, today the markets are overvalued. And the markets will go from 100 to 70 and back to 120. So these are the times when the markets are volatile and they are likely to go down and then again rise back over a period of time. In a similar 12 intervals, SIP would have helped you accumulate 1260 units at an average price of 95 rupees. And lump sum, similar to the previous example, it would have bought you 1200 units at 100 rupees. Now, in this scenario, you can see that SIP investing would have generated a much higher value, final value at 1,50,000 rupees, and lump sum would have generated 1,44,000 rupees. So what does it tell you is that SIP does better in a volatile falling markets or at the point when the markets are overvalued at the start. So if you think that markets today or Nifty PE ratio today is higher than the long-term median of 28, you can assume that there is a chance of market being overvalued. The other way to think of it is that if the long-term 10-year, 15-year SIP returns of Nifty are higher than the 12% CAGR, the chances are the markets are overvalued. In that case, you can choose SIP over lump sum and probably that will yield a better result. Once again, I want to highlight that these are just a thumb rule and not necessarily a definite formula to make a choice. Now, what should investors do? Now, we often find this difficult that how do you time the market? Whether the markets are going to rise in short term or they're going to fall in short term. I think for most of us, including the experts, this is a very difficult choice and most of them go wrong. Even if they go to get it right once or twice, if you keep doing it on multiple occasions, you will get it wrong at some day. Now, what usually happens is that investors and fund managers are very optimistic near market peaks. And why that happens is because that economy is humming, the companies are guiding for great growth prospects, recent returns are very strong, and the flows into the mutual funds are very high. At that time, the confidence level are so high, we think that nothing can go wrong. But these are the exact times when you have to reduce your equity allocation because at that time, the upside potential of the market could be low and there is a very big risk of downside. At the same time, when markets are not doing well, the factories are shutting down, people have lost jobs, and there are no inflows into the mutual fund. These are the times when market could be actually undervalued and the best time to invest. But because of the news flow around, we will not be able to invest enough. And that's the reason leads to mistiming of purchases and sales. So does it make sense to fall into so much of timing decision? Isn't it hard just to get it right? So I think SIP is a much better way to go about it because like we saw in the previous example, SIP also delivers a reasonably good return in all scenarios. Now, SIP can be said that in some scenarios, even if it is slightly inferior option, it is still better than doing something vastly inferior than SIP. So SIP takes away your timing skills. number one. And number two, it is perfectly coincides with your regular income or a salary which you get, which will definitely, work for all practical reasons. So that's why I wanted to communicate that SIP could be a very good friend of investors, and that can be used as a go-to tool for investing in mutual funds. Thank you.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.